Welcome to part 2 of Williams Mullen's series on mezzanine lending. And in this part, we will be looking at why mezzanine loans are attractive to borrowers. So let me hand over first to my colleague, Randal Greene, to start off this analysis. Randal.
Thanks, Bob. So I'm going to outline a couple of key reasons why mezzanine loans are a good option for borrowers. And one main reason is that they allow the borrower to leverage more of the purchase price for the acquisition of the underlying real estate. As we discussed in part 1, the senior loan is typically 65 to 75% of the purchase price. Though with COVID, we have seen some senior lenders limit that to 65% of the purchase price. And that just leaves the borrower with a lot of ground to cover in order to be able to pay the purchase price. So borrowers really have two main options to bridge this gap. They can contribute or raise additional equity, or they can get a second loan. And in some cases, the borrower may be unwilling or unable to contribute or raise additional equity to bridge this gap. And a mezzanine loan provides a good option. By adding a mezzanine loan to the capital stack, the borrower can increase the loan to value ratio to 80 or 90%, significantly reducing the amount of equity that the borrower needs to come up with in order to fund the purchase price. And that frees up capital for other purposes, and it can result in a higher return on the equity that the borrower does contribute, since the borrower's equity won't be diluted by bringing in additional investors. Another upside is that in markets where property values are rising or deals are difficult to find, it may be easier to secure a mezzanine loan than it is to bring in additional equity investors. Mezzanine loans are also a good solution for startup companies without a borrowing history, a significant or a successful transaction record, or who just simply don't have sufficient cash to fund their growth. And the reason is that mezzanine lenders are typically just more willing to provide funds to startup type companies than equity investors are. Another benefit to borrowers is that, unlike equity, mezzanine loans are not permanent. They can always be paid off and the lender can be replaced. Whereas with equity, generally there's no right to buy out equity participants absent a deadlock. Also, one final point is, with equity, the borrower potentially gives up some control rights that it has over its business to equity investors, and whereas mezz lenders are generally passive in terms of the day-to-day operations of the business, outside of those typical major decisions.
The other thing that you'll sometimes hear about mezzanine loans as well is that they are cheaper than equity in situations where obviously the rates for mezzanine loans fluctuate. But if you're in a market where you have an investor group, and as the person putting together a transaction, you are eligible to be paid a promote when that equity group has achieved a certain return on its capital. If you can borrow mezzanine money for a cheaper rate than that hurdle rate to get to your promote, that is definitely beneficial to you. And so for that reason, you see a lot of borrowers who are interested in having mezzanine loans rather than additional equity for them. Another reason that people are interested in mezzanine loans is that certain lenders are more willing to advance for certain assets a loan amount rather than equity. One example of that is an industry that Randal and I are actively involved in, which is senior housing. Senior housing at one time was seen as a very risky investment, and there was a lot of equity that took off from that particular market, and people were concerned about the plaintiffs' bar suing all parties involved in senior housing assets. As a lender, you don't normally run the risk of having the plaintiff's bar name you as a defendant and sue you when all you are doing is lending money to a business and you are not an investor in that business who can be alleged to be controlling that business. So in that type of industry, or industries where there may be environmental risks, etc., those are places that borrowers are always keen to find mezzanine money because it may be available. The other thing to bear in mind about mezz loans is you may be able to structure a mezz loan for a longer investment horizon than your equity is willing to provide. Many equity providers look at a 3 to 5 year, sometimes 7-year horizon to make an investment in an asset, develop that asset, allow it to mature, and then dispose of that asset. That's quite a tight window. And if your horizon suggests that it may take longer than that for the asset to be matured or stabilized, then a mezzanine loan that is structured over a longer term can be exceedingly beneficial. I think the bottom line for borrowers is, with all those various reasons, the mezzanine loan provides additional flexibility to those borrowers. It's just another tool in the toolkit of borrowers who are doing transactions to enable them to find enough money to make the transaction work, to structure it in a way where you have adequate control over the assets that you are buying, and allows you to be able to sell those assets and exit the investment when it suits you. So for all those reasons, it remains attractive. That concludes part 2. In part 3, we will be examining why mezzanine loans are attractive to lenders. I hope you can join us for that.